Inflation in Switzerland has never been this high since 1993. That's why the SNB raised interest rates further in September to 0.5%. Borrowing money became costly again. At the same time, banks still have plenty of money. Why should they suddenly pay for money when they already have more than enough of it? And how much will the interest rate hike cost the SNB and indirectly all of us? Find out now in the Geldcast update.
Geldcast Update mit Fabio Canetg.
Today we're talking about something that is not too easy, namely the money market, the market where banks lend money to each other. I decided to talk about this difficult topic anyway because it's essentially about our money. In the future, the SNB will transfer billions of francs to the banks instead of to the Confederation and the cantons. And I think we should all understand why this is. Let's do this together. When the SNB conducts monetary policy, it announces an interest rate target, the SNB policy rate. That is where it wants the so-called money market rate to be. This is the interest rate at which banks lend money to each other. The SNB now wants this interest rate to be at 0.5%. However, the SNB cannot force banks to lend and borrow at 0.5%. The SNB must ensure that banks voluntarily agree that the SNB key interest rate, 0.5%, is the right one. How is the SNB doing that? Let's take a step back. All banks have an account with the Swiss National Bank. There, they have recently been credited with the SNB policy rate, currently 0.5%. Banks cannot lend their balances with the SNB to you and me. When banks give you and me a loan, new money is created, but that's something to discuss in another Geldcast update. So what can banks do with their balances with the Swiss National Bank? Roughly speaking, two things. First, they can simply leave their money on their account at the Swiss National Bank. Then they receive the SNB policy rate, currently 0.5%. Alternatively, they could lend their money to other banks. However, this only pays off if they also receive at least the SNB policy rate in return. For these reasons, banks that receive 0.5% interest on their balances with the SNB also charge at least 0.5% interest on their loans to other banks. So much for the theory. In practice, however, there are now banks that do not receive the SNB policy rate on the entire balance. This is because the SNB only pays a positive interest rate up to a bank-specific limit. Banks that have a lot of money in their account will only be credited with the SNB policy rate up to this limit. Anything above that does not bear any interest. Why is that? The goal is that banks continue lending money to each other. Banks with a lot of money try to get rid of some of their money. This is profitable because otherwise they would not receive any interest on this money. And for the borrowing bank, this is profitable too because it can now invest the borrowed money on its bank accounts with the Swiss National Bank at 0.5%. That means the so-called money market interest rate, the SARON, settles between 0 and 0.5%. The problem is that no one knows exactly where the interest rate would settle in such a system. Let's take an example. The borrowing bank could say, I only accept money from another bank if I get it very cheaply for, let's say, 0.1%. Then the SARON would be at 0.1% and not at the Swiss National Bank's policy rate of 0.5% where it wants it to be. To ensure that the SARON is closer to 0.5% than to zero, the SNB now offers all banks the opportunity to invest their money at 0.5%. by means of specifically created transactions and securities. For the experts, this refers to reverse repos and SNB bills. Banks therefore receive interest on their bank accounts with the SNB up to a certain limit. And for the overriding non-interest-bearing money, the SNB has created new instruments in which banks can invest, where they also receive approximately the SNB key interest rate, the policy rate 0.5%. This means that the banks always have the opportunity to earn 0.5% with their money somewhere. For most banks, it is no longer interesting to lend their money to another banks at less than 0.5%. The SARON thus settles slightly below 0.5%. The SNB's new system works pretty well. Just a few days after the interest rate hike in September 2022, SARON was already at 0.38%. It is at least close to the SNB's policy rate. But the whole thing comes at a cost. It costs the SNB a ton of money because it has to pay interest to the banks. The SNB is expected to transfer at least 7 billion to the banks next year. The SNB didn't have to do that in the past. That is 7 billion Swiss francs that do not end up in the distribution reserves. The distribution reserves are the funds that sooner or later flow to the Confederation and the cantons. But does the SNB really have to pay so much money to the banks to have the money market rates where it wants it to be? The answer is no. The SNB could, for example, not pay interest on the bank's minimum reserves. The banks have to hold the minimum reserves anyway on their bank accounts with the Swiss National Bank. In other words, the banks do not lend their minimum reserves to other banks anyway, no matter how high or low the interest rate on it would be. It is possible that the SNB could decide not to pay interest rate up to a multiple of the minimum reserves without affecting the SARON. Let me sum up. The Swiss National Bank is now paying banks a positive interest rate on their balances up to a certain limit. Balances above the limit will not bear interest. To ensure that the interest rate on the loans between banks is not too low, the SNB also gives all banks the opportunity to invest their money in new instruments like SNB bills or reverse repos. Taken together, this means that the money market interest rate, the SARON, is close to the SNB's policy rate at 0.5% at the moment. However, SARON would probably be close to the SNB's policy rate even if, for example, the SNB did not pay any interest on the bank's minimum reserves. To be more clear, the Swiss National Bank transfers an unnecessary amount of money to the financial sector. If it did not pay interest on at least the minimum reserves, less money would flow from the Swiss National Bank to the banks, leaving more money for the Confederation and the cantons.
Geldcast Update mit Fabio Canetg.